As the week draws to a close, we open a window at what next week has in store for the markets. On the monetary level, the scenery is dominated by the interest rate decisions of the Fed on Wednesday and UK BOEs on Thursday. Yet on Thursday, we also note from Sweden Riksbank's interest rate decision. As for financial releases, we make a start on Monday with Sweden's preliminary GDP rate for Q4, while on Tuesday we get Q4's preliminary GDP rates of France, the Czech Republic, Germany, indicator, Eurozone's economic sentiment for January, and from the US, the December JOLTS job openings. On Wednesday, we begin with the release of Japan's preliminary industrial output for December, Australia's CPI rates for Q4, China's MBS manufacturing PMI figure for January, UK's nationwide house prices for the same month, France's and Germany's preliminary HICP rates for January, the US ADP national employment figure for the same month, and Canada's GDP rates for November. On Thursday, we note the release of Australia's building approvals for December, China's Caixin manufacturing PMI figure for January, Eurozone's preliminary HICP rates for January, the US weekly initial jobless claims figure, Canada's manufacturing PMI figure for January, and the US ISM manufacturing PMI figure for the same month. On Friday, we highlight the release from the US of the employment report for January and also note the release of the factory orders for December and the final University of Michigan consumer sentiment for January. The US dollar is about to end the week in the greens against its counterparts and may have gotten also some support from the less than expected deceleration of the US GDP advance rate for Q4, which tends to underscore the narrative for a possible soft landing of the US economy. For the coming week, we highlight two issues, with the first being the Fed's interest rate decision on Wednesday. The bank is widely expected to remain on hold at the range of 5.25% and 5.5%, yet the market tends to expect the bank to start cutting rates from May onwards and deliver a total of 5 rate cuts in the current year. Hence, we expect market attention to be placed on the accompanying statement and Fed Chairman Powell's press conference later on. Should the bank contradict market expectations and imply that rate cuts are to be delayed beyond the May meeting, we may see the US dollar getting some support. The second event we highlight would be the release of the US employment report for January on Friday. The data are expected to show an easing of the US employment market's tightness in December, yet forecasts of the US employment data have been disproven a number of times in the past, thus an element of uncertainty is present for the release, which may raise volatility for the markets. Should the data show that the employment market has not lost from the tightness reported in December, we may see the US dollar gaining asymmetrically, as it would add more pressure on the Fed to keep rates at high levels for a prolonged period, given the bank's dual mandate. The pound is about to end the week stronger against the euro, yet near the same levels against the JPY and USD. On macroeconomic level, we note the better than expected preliminary services PMI figure for January, thus improving the outlook for the UK economy and supporting the pound. Yet the CBI indicators showed wide pessimism for industrial orders. On a monetary level, we highlight the release of BOE's interest rate decision that may prove to be the main event for pound traders next week. The bank is widely expected to remain on hold. It should be noted that the UK CPI rates slowed down considerably over the past year, yet jumped slightly in December. The release tended to showcase that there is still work to be done before inflation returns to the bank's 2% target. Hence, we would expect the bank to maintain a confident tone in the accompanying statement, implying that rate cuts may happen within the year, yet that it would be premature to start discussing them. Such a scenario may provide some support for the pound, especially if it's implied that the rate cuts are due after the summer. JPY is about to end the week with some slight gains against the US dollar and the euro and remains relatively unchanged against the GBP. On a monetary level, we know that BOJ remained on hold, as was widely expected in its interest rate decision on Tuesday. Moreover, in the bank's accompanying statement, the BOJ stated that it would continue with quantitative and qualitative monetary easing with yield curve control. Yet, during the BOJ press conference, Governor Weathers reaffirming that the BOJ will end its negative interest rate policy once 2% inflation is achieved, may have provided some support for JPY, as the bank seems to maintain a tendency towards normalizing its ultra-loose monetary policy. On a macroeconomic level, the slowdown of inflationary pressures on a headline and core level for December, as mentioned in last week's report, tends to decrease the creditworthiness of BOJ's narrative and could intensify carry trade, which in turn may weaken JPY. Furthermore, we also note the slowdown of Tokyo CPI rates for January, which tends to act as a barometer for inflation nationwide, given the density of the Japanese megacities population. On a more fundamental level, we note the dual nature of JPY as a safe haven and national currency. Hence, should a more risk-oriented approach be adopted by the market next week, we may see JPY experiencing some outflows. The euro is about to end the week lower against the US dollar, the pound and the JPY in a sign of a wider weakness. It should be noted that the euro is falling even despite ECB's interest rate decision. The bank, as was widely expected, remained on hold. In the bank's accompanying statement, there were no major surprises, yet in her press conference, ECB President Christine Lagarde stated that there was a consensus at the table that it's premature to talk about rate cuts. Overall, we tend to see the case for the bank to push any rate cuts for a later stage than what was expected by the markets, possibly around summer 2024. For the time being, the market seems to remain unconvinced and expects the bank to deliver 5, even maybe 6 rate cuts within the year, and the meeting may have contributed to the bearish tendencies of the euro. On a macroeconomic level, we note that economic activity in Germany's manufacturing sector, despite shrinking, we note that it seems to have contracted to a lesser degree in January, according to the preliminary PMI figures for the current month. Overall, the situation seems to be improving for the manufacturing sector of the Eurozone as a whole, yet the fact that economic activity is still contracting seems to be clipping the optimism for the outlook of the Eurozone. We expect the area to have a difficult first half of 2024, something that may be reflected in the preliminary GDP rates for Q4 next week. AUD is about to end the week relatively unchanged against the US dollar after 3 consecutive weeks of losses. Aussie traders are expected to keep a close eye over developments in China, given the close Sino-Australian economic ties. We note that Chinese factories seem to be struggling to increase economic activity. Hence, we highlight the release of China's manufacturing PMI figures for January on Wednesday and Thursday. Should economic activity in China's manufacturing sector contract, we may see it weighing on AUD, as it would imply a possible easing of Australian exports of raw materials towards the Chinese mainland. On a macroeconomic level, we highlight the release of Australia's December and Q4 CPI rates on Wednesday's Asian session. The release gains on importance given the release of RBA's interest rate decision 6 days later. Should the rates continue to decelerate, we may see the Aussie losing ground, as RBA would be justified to ease on its hawkish knives, while a possible failure of the rate to slow down may instigate worries for the bank to maintain rates high for a longer period and could support the Aussie. The loonie is losing ground against the US dollar for a 5th week in a row. On a macroeconomic level, we note that last week, the producer prices contracted deeper into the negatives for December in a prelude for a possible further easing of inflationary pressures in the Canadian economy. The idea was further enhanced by contraction of the retail sales growth rate for November. In the coming week, we note the release of Canada's GDP rate for November, and a possible contraction could weaken the loonie. On a monetary level, we note that BOC remained on hold, as was widely expected, keeping rates at 5%, yet quantitative tightening continues straining Canada's financial environment indirectly further. The accompanying statement could be perceived as implying that the bank may delay any rate cuts given the persistence of underlying inflation. On a fundamental level, we keep an eye out for oil prices, given the traditional positive correlation of the CAD with oil prices. The rise of oil prices seems to have failed to provide some support for the USD in the current week. For the time being, it seems that the weather conditions in the US, the tight US oil market, China's stimulus package, and rising tensions with Houthi rebels could provide some support for oil prices. Should oil prices rise in the coming week, we may see some support for the CAD as well on a fundamental level. As a general comment, we expect the US dollar to increase its influence over other currencies in the FX market, given the gravity of US financial releases and monetary events. On the other hand, there are a number of financial releases that may allow various currencies to come under the spotlight and thus create a more balanced trading mix. As for US stock markets, we note some mixed signals coming from major US equities market indexes, where Nasdaq and S&P 500 are to end the week in the greens, but not Dow Jones. The earnings season is still on, and headlines are continuously reeling in, maybe with Tesla's being the most high-profile company losing in the market value given its earnings report. In the coming week, we know that on Tuesday we get the earnings reports of Pfizer, General Motors, Microsoft, and Google. On Wednesday, Boeing. On Thursday, Meta, Deutsche Bank, Amazon, Apple, Ferrari, and on Friday, ExxonMobil. We tend to focus on the tech sector, given the high number of high-profile companies in the particular sector that are to release the earnings reports next week. Overall, should the market sentiment turn more cautious in the coming week, we may see US stock markets falling somewhat. As for gold's price, we note that it's the second week that gold is about to end in the reds. It seems that the negative correlation of the USD with gold was maintained this week, and the relative strengthening of the US dollar weighed on gold's price. Should the US dollar continue to strengthen over the coming week, we may see gold's price falling to lower grounds. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
Hello everyone, my name is Emily and welcome to another video. Today we're going to talk about automated trading systems. Automated trading systems, also referred to as algorithm trading, involves the use of an algorithm to execute trades according to the predetermined criteria. The systems allow traders to establish specific rules for both trade entries and exits. Once these are programmed, they can be automatically executed by a computer. The benefits of automated trading include more trading uptime, minimizing the impact of emotions during the trading process, and faster execution. To get started with automated trading systems, you need to decide whether you want to build your own system or use a third-party algorithm. If you build your own system, you can choose every aspect of the strategy and have a better understanding of how the system works. It could open and close trades based on timing or price, using technical indicators to confirm your entry and exit points. For example, you could build a system to automatically buy 100 Netflix shares when its 50-day moving average goes above the 200-day average. Or you can automatically sell 100 Netflix shares if the market reaches volatility levels you are not happy with. If you are not confident enough to build your own system, you can use a third-party solution instead. This works in a similar way to a self-built system, opening and closing trades according to set criteria. However, you will have less control over the customization of these parameters. Whether you build your own automated system or use one which has been pre-built, it's important to backtest it thoroughly to make sure it works in the way you want before you put it to work on the live markets. MT4 is popular if you want a third-party solution because MT4 provides a marketplace where you can conveniently access pre-built algorithms to get started with automated trading. It's important to note, though, that automated trading systems have some downfalls that you should be aware of, like the possibility of mechanical failures. For instance, if an internet connection is lost, an order might not be sent to the market. Automated trading systems need to be monitored because of the potential for technology failures, such as connectivity issues, power losses, or computer crashes. Automated trading system can experience anomalies which could result in wrong orders, missing orders, or duplicate orders. If the system is monitored, then situations like this can be identified and resolved quickly. Thank you so much for watching us today, guys. Bye-bye.
Okay, so welcome to this week's trade management webinar. So today we're going to be talking about trailing stop loss. So as per usual, before we get started, a risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so I'm Melanie, and I am your host for today. I'm an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. Okay, we will firstly talk about the anatomy of a trade, followed by some recap of last week and the previous week's information, some trade management techniques, just a really brief recap on those, and then we'll jump straight into this week's trailing stop loss techniques, and we'll look at some examples of them as well. And if we have time at the end, we'll also go through a couple of live analysis charts. So feel free to pop into the chat if you have any questions or any requests for any charts that you guys would like to see. Okay. Now let's go ahead and get started. So the anatomy of a trade. Firstly, of course, we have our entry, stop loss, and take profit, and then followed by our break even, partial profit, trading stop, and idea invalidation. So let's look at. I think if you were here at our previous webinars part of this series, you would know that you would know what exactly these break-even, partial profit, trading stop means, or idea validation rather. But not to worry, if you weren't here, I'll just do a brief recap right now. Okay. Okay, so firstly, let's look at our take profit stop loss placement recap. So we typically would recommend you to place your stop loss beyond a major resistance area and your take profit before a major resistance area. So if you're wondering about this, let me just pull up the Forex Army website so that you guys can see. So if you're new to technical analysis, right? If you're new to technical analysis, you can actually just go to this website. Let me just pop it into the chat in a bit. But go to this website and then you guys can look at all the different Fibonacci techniques. Yeah, here. So we typically will recommend you to place your take profit before a major confluence area and after a major confluence area for your stop loss. So in this case, we are looking at a buy entry. In this example that I have here on my slides, obviously we are talking about a sell entry since our take profit is below instead of above. Okay, so I just wanted to pull this out to show you guys the variations if you're looking at a buy entry versus if you're looking at a sell entry. So maybe I'll just type out the website in the chat. It's the forexarmy.com. Okay. Yeah, you can go ahead and explore that website on your own. And okay, so we went through this in our very first part of the trade management series. Okay, next we're gonna look at break even. So break even is basically a level in which you are in profit and recognize that there is a risk of reversal. So it's basically you saying that if you are right, then your price should go all the way to your target, but if it goes back to your entry, then you are wrong and you should get out. So over here we have an entry at the breakout. Over here, okay, so we have two multiple swing high resistances, and we're going in for our entry at this breakout of this resistance level. Okay, so we're hoping for price to push past our take profit, which is over here, the green area here. So we take note of our original stop loss, which is below here at this swing low. Okay, and at point 3, which is over here, that's where our break even was triggered. So it's where our break even is triggered because your break even level, which is typically in between your entry and your take profit level. So we've chosen this area since it's a swing high resistance level. Okay, so we are going in for a buy. We're expecting price to rise from our entry all the way to this level here. Okay, and we see that price has reversed off of our break even, and that's where our break even is triggered. So we are going in and moving our original stop loss over to our entry instead. Okay, so you see me keep constantly looking to the side, it's because my monitor is over here. Okay, but yeah, so our break even is triggered. We are moving our stop loss over to this entry level so that if price continues in our favor, which you see it originally did, okay, it's continued, broke out of the break even resistance level and hit it towards our take profit, then of course that's good news. But if it reverses, you can get out at break even and your position is protected. Okay. Okay, so in our second part of the series, we talked about break even and partial profit. So we just talked about break even. Now let's look at partial profit. So partial profit basically means, as the name implies, you get a partial profit of your trade because the trade perhaps didn't meet your expectations, didn't hit your take profit, but it hit halfway or maybe 3/4 of your trade. So in this example, we are going in for a buy entry at our first support level. Okay, so our first support level is at the 0.68736 level, and our stop loss is placed slightly below that at a overlap support level. As you can see, there is a swing low here and a swing high here. Okay, so we place our stop loss slightly below that, and our take profit is over here at 0.70512, and it's at this swing high resistance. Okay, we have a couple of Fibonacci levels to support our levels as well. So firstly, we have a 61.8% Fibonacci projection. Okay, that lines up with our take profit, but excuse me. But then we also notice that we also have a 78.6% Fibonacci projection and a 38.2% Fibonacci retracement that lines up nicely with our partial profit. So if you're thinking where exactly should you place a partial profit, firstly, you can pick any levels that's in between your first support and take profit. You can look for levels that have a swing low or swing high. That's basically how you identify levels. Okay, that's the first step. Next, you could maybe look at supporting that level with Fibonacci levels like we have done over here. So you can see our partial profits at the swing low level. Okay, but it's also supported with two Fibonacci levels, making it a pretty significant Fibonacci confluence area. Okay, so we're expecting price to rise to our take profit, of course, but there is a strong resistance at this Fibonacci confluence area, so that's why we're placing our partial profit there, just in case price isn't strong enough to push past that area. So you can see price testing this area now. Okay, yeah, so you can see price testing that area, and it's reacting off of it, but we're not sure if it's actually gonna surpass that area or break out of that area. Okay, and you can see that it actually reversed off and hit it back down. So we did get out of our trade with a slight partial profit, even though it didn't hit our take profit. Okay. Next, we have idea invalidation. So we went through this last week as the third part of our series. So idea invalidation is usually placed before your stop loss. So it's basically the opposite of your break-even levels. So for break-even, we would move our stop loss to our entry, but in this case, we are moving our take profit to our entry instead. Okay, if I sound a little bit sick, it's because I'm just recovering, so bear with me in that. But okay, so it's the level at which you basically admit that you are wrong and you want to get out of the trade ASAP. So when this level is reached, your take profits move to your entry, giving you a small chance to get out at break even. So in this example, we're looking at your entry at this double swing high level. Okay, we see price dropping, reversing off of that resistance and heading downwards to our take profit. You can see how we've placed our take profit before a major confluence area or major resistance area. As you can see here, we have 3 swing lows. So we're placing our take profit slightly above that. Here we see price reverse and it's heading up towards our stop loss. Okay, so the point in which your idea validation is triggered is at this point. Your idea validation, as we mentioned earlier, is placed in between your stop loss and your entry level. So we've chosen the swing high level here. So once price hits that level, even if it does reverse back down towards your favor, we're moving our take profit upwards to our entry so that we get out of the trade at break even before price rises even further and stops us out. Okay. Okay. Let's look at some examples now. So in this example, we have a swing low here. And we've placed our buy entry at that swing low. And we have a Fibonacci, 50% Fibonacci retracement that supports our take profit level. Our take profit level, as you can see here, is an overlap level because we have a swing low and a swing high that line up nicely at that level. Okay. So you can see our entry, so our entry is at that level. And now we are going in with our Fibonacci extensions as well as expansions. So if you're not familiar with what those are, we basically go through those in our Fibonacci series. But you can also check them out on the forexarmy.com, which is the website that I have included in our chat. Okay, but basically you can see how our 127.2 and the minus 27% line up nicely. So I'll show you guys in a little bit during our live analysis session how you can obtain these levels. Okay. Okay, but yeah, for now you just look at these levels, see how they're aligning. That's basically giving us a Fibonacci Fibonacci confluence area. Okay, so yep, so you can see entry and our price. So we're placing our stop loss below our Fibonacci confluence area here. Just like we mentioned, we always want to place our stop loss beyond any confluence areas. Okay. And now our idea and validation, we are placing exactly at that level. Okay, so if price breaks out of our entry, hits downwards towards our stop loss, okay, at least when it hits our idea and validation, we will get out at break even. You can see that's exactly what happened over here. Okay. And then once it hits our idea and validation, we then move our take profit down towards our entry. Okay, so that we get out at break even. Okay, that's basically it. Yeah, so if we didn't do that, price would have stopped us out because price actually continued to drop. Okay, so now let's look at this week's topic, which is our trailing stop loss. Okay, so trailing stop loss is basically a type of stop loss order that is set at a certain percentage or dollar amount away from the market price. The idea behind a trailing stop loss is to lock in profits while giving the trade room to breathe, as the stop loss follows the market price as it moves in favor of the trade. So, this example that I have over here is in terms of stock prices. But it's just to give you an idea of how it works. So let's say you buy a stock at $100 and you set a trailing stop loss at $10. As the stock price rises to $110, the stop loss will follow, now at $100, because 110 minus $10. So if excuse me, if the stock price drops to $100, your stop loss will trigger, selling your position and protecting your profits. The trailing stop loss technique can be useful for traders because it allows them to manage risk and lock in profits dynamically as the market moves. Okay, so this is different from a fixed stop loss, which is set at a specific price and does not change as the market moves. So it's important to note that the trailing stop loss is not a guarantee that you will exit a trade at the desired price. Market conditions such as gaps or rapid price movements can trigger stop loss order before it reaches the desired level, leading to an unexpected exit from the trade. Therefore, it's important to use trailing stop loss in combination with a solid risk management strategy. So if you combine this with all of the methods that we've mentioned above, and throughout the past 3 webinars, you're pretty much set for your trade management strategy. Okay, so here are the different methods of a trading stop loss. You can see we have moving averages, chandelier, parabolic SAR, ATR, so on and so forth. Okay, even support and resistance levels and a combination of these methods. So let's go through our first example, which is the moving average. So in this example, we are going in for sell entry at this level here with a 1.57891 level. Okay, so once price breaks out of that area, then we're going in for a sell. And the reason for that is because you can see that we have an ascending trend line. Okay, so what makes an ascending trend line valid is if there are 3 touches on it. You can see very clearly over here we have 1, 2, and 3. Okay, and on our third point, you can see price breaking out of that ascending trend line and also breaking below that overlap support level. Okay, so it's breaking below it and we're going in for a sell. So you can see here, price has continued to drop. Okay, and price is moving below our moving average, which is typically a sign that a bearish signal. Okay, if price moves below your moving average, it's typically a bearish signal. And once you see price cross over your indicator, that's a sign that that the trend might change, and that's when your trailing stop loss is triggered. Excuse me. Okay, so that got us out of the trade before price started to move upwards. Okay, pretty self-explanatory. Now let's look at a trend line breakout. So we have one trend line here, but we have another one over here, as you can see. Okay, and so price is moving in this descending trend line, and we see price breaking out of our descending trend line. So that's typically a sign that trend is going to change as well, and your trend line trading stop loss is triggered, so you get out of your trade, of your selling trade. Okay, if we look at our parabolic saw, pretty similar in logic, I guess. In this case, we see price moving below the indicator, so it's also a bearish signal. And then we start to see price giving us this, price moving above our parabolic saw. So it's giving us a bullish signal. And then we see price crossing over our indicator. So then our parabolic saw trading stop loss is triggered. Okay, now if we look at chandelier and ATR trailing stop loss, okay, we have our sell entry at that same spot. Okay, and price is moving below these indicators, so it's a bearish signal. And once price crosses over these indicators, our ATR stop is triggered, chandelier stop is triggered, and you get out of the trade. Okay, pretty self-explanatory there. Yeah, so if we combine different indicators, obviously your trailing stop loss will be more effective. So here we see our moving average indicator being used. So price is breaking below our sell entry as well as our moving average. So it's giving us a bearish signal. So we're going in for a buy, or rather for a sell towards our take profit. And you can see we've placed our fixed stop loss over here, right at this swing high here. Okay, but we're going in for a sell towards our take profit, and once price crosses over the moving average indicator, that's a sign for us to get out of the trade, because it's typically a sign that the trend is changing. Okay, similarly for this example as well. Okay, using breakouts as trading stop loss. So breakouts are usually high volatility events, and price can spike up and reverse almost as quickly. So stop loss will help you to manage risk and protect your capital, and a trailing stop loss can help you to protect your profit. So in this example, we're using chandelier and ATR. Okay, so we see, and we're also using support and resistance here. Okay, so you can see that we're going in for maybe a buy entry here. Okay, so we're seeing price moving above our indicators, which is a bullish signal. Once price kind of starts to cross over each other, that's a sign that the trend is going to change. Similarly, over here, we are using support and resistance to highlight the different levels that we want to pay attention to. And then we're seeing price moving above the the indicators. So once again, a bullish signal, and once price crosses below the in this case, it's a resistance. Okay, so once price crosses over this resistance level and it also crosses over our indicator, that's a sign that the trend is about to change. Similarly, for this example, we are using a moving average indicator instead. Okay, but it's the same concept. You see price moving above the indicator, it's a bullish signal. If it's moving below, you can see it's a bearish signal. And if it crosses over, it's typically a sign that the trend is about to change. Okay, that's about it for my slides. We still have a bit of time left, so we can take a look at some charts. Let me just pull up my charts really quickly. Okay, let's maybe go ahead and look at gold first. Okay, okay, so starting off, we're gonna look at our weekly time frame. Okay, so on our weekly time frame, okay, let me just make sure that okay. So on our weekly time frame, okay, this is what our charts look like. It's pretty bearish, okay. On our daily time frame, also pretty bearish. Okay, now let's look at our 4-hour time frame. Okay, first on our daily time frame, let's add some support and resistance levels. So firstly, this is our first resistance. Okay, and then our first support. And maybe a second support here. Okay, now let's look at our 4-hour time frame. Okay, I think this would be my first support instead now, because it's closer to where price is at. And then this would be my second support. Okay, now let's go in with some Fibonacci levels. Okay, I'm first gonna go in with a Fibonacci projection. So I have my 61.8% that lines up nicely with my first resistance. Okay, and next let's go in with a retracement. So my 38.2 lines up nicely with my 61.8. Okay, and over here I can see this level, 50% lines up with the 23.6. So I'm just going to keep those two as well. Okay, so I'm actually going to add a level here because this is an intermediate level. Okay, because I have Fibonacci confluence area here, and I also have some swing highs over here. Okay, now let's go in with some indicators. Okay, price is moving above our Ichimoku cloud, so it doesn't support our bearish analysis, but on our MACD it is bearish. So I'll just get rid of our Ichimoku. Now let's look at RSI. Okay, RSI isn't telling us much. Let's look at stochastic. Okay, on our stochastic, we are seeing a bearish divergence. Okay, so between these two lines, you can see price is pretty price has stayed the same level at our first support, but on our stochastic, okay, it gives us a price is making a lower low. Okay, so that's a bearish divergence. Now let's look at moving averages. Let's look at MA, simple, and exponential. Okay, price is moving below both of these indicators, though it does look like price is breaking out of our EMA or SMA. So I might remove that. Okay, because it doesn't support our analysis. Okay, that's about it for our dollar franc. Okay, so we will definitely see price testing this level a bit. Okay, we'll see price testing this level because of the confluence area as well as the overlap levels. But yep, I think ultimately it will continue in the downward because of the downward pressure. Okay. Okay. I think we still have a bit of time left, so let's look at gold. Okay. Same thing, we're gonna look at the higher time frames first. Yep, I think this video, this because this webinar is being recorded, so I think they will upload this onto YouTube. So I think you will be able to get it there. But if not, I think you can email the IronFX team and they'll be happy to help you out. But it is being recorded, so you should be on YouTube. Okay, so on our weekly time frames, we can see it's pretty bullish, right? On our daily time frame, okay, on our daily time frame, we can't really tell because it's kind of trending. Okay, now let's just go in with our support and resistance levels first. Okay, and for my first support, meet me here. Okay, and okay, now on our 4-hour time frame, okay, most of these levels still hold up on our 4-hour time frame. But I think instead, I want to place my first support here instead. Okay. Second resistance maybe here. Okay, now let's go in with our Fibonacci levels again. So I can see my 78.6 lines up nicely. I want to see if my 61.8 lines up with any other important Fibonacci levels. Okay, so I will test that in a bit. Now let's look at projection. So 61.8. Okay, all of these levels price has already broken out of, so that's no longer valid. Hmm. So I think that's all the levels that we have. Okay, my 61.8 lines up nicely, and my 50% as well. Okay. That's all the levels that we have here. I'm actually going to remove the 61.8 because can't find any other levels to match up with that, as well as our 50%. Okay, now let's go in with our indicators. I'm going to use MACD, Ichimoku, and RSI again, because at one glance you can see exactly what the signals are. So on our Ichimoku, you can see that price is moving below the Ichimoku cloud, so it's giving us a bearish signal. On our MACD, you can see it is giving us a bit of a bullish signal, so I'm just going to remove that. Okay, on our RSI, okay, price is actually giving us a bullish signal here. Okay, because it is breaking out of the descending trend over here. So I'm gonna move that. Let's see. Oop. Let's look at moving averages. Okay, Price is moving below both of the moving averages, so it supports our bearish signals. And let's look at Bollinger Bands. Okay, Bollinger Bands aren't really telling us much, so remove that. Okay, let's look at stochastic. Okay, stochastic gives us a descending trend line, so that also supports our bearish signal. Okay, so because there are so many indicators, it's important to just pick a couple that you are comfortable using and that you know how to use properly. Yep, and then just flip through those few after you're done doing your Fibonacci as well as graphical analysis. And then, yeah, just go from there. So if majority of your chosen indicators give you an opposite signal of what you are going for, then maybe you can go back and check your analysis again. But normally, if you've done it properly, most should support your own analysis. Maybe not all, like you've seen over here, RSI didn't support, RSI and MACD didn't support this analysis, but you can see that my stochastic, my moving averages, as well as my Ichimoku all support my analysis. So yeah, let me know if you guys have any other questions. Okay, if there are no other questions, that's it from me for today. Thank you guys so much for joining me. I am so sorry for my voice. I'm just recovering from the flu, but I will be better next week, hopefully. And I'll see you guys then. Have a great rest of your week, everyone. Bye. No worries. I'm sure I'll be better by next week. Thank you. Bye, guys.